Picture a young boy in Omaha, Nebraska, in the 1940s, selling chewing gum and Coca-Cola door to door. This isn't just any boy. This is Warren Buffett, a name now synonymous with wealth and investment genius. But back then, he was a child with a keen eye for business and an insatiable curiosity. From an early age, Buffett displayed an entrepreneurial spirit. He didn't just sell gum and soda. He was learning the ropes of the market, understanding the value of hard work and perseverance. These weren't just childhood ventures. They were the first steps on a path that would lead him to become one of the world's greatest investors. But Buffett's interest didn't stop at door-to-door sales. His fascination with data and patterns showed in his unusual hobbies. Collecting bottle caps, noting down car license plates may seem like simple child's play, but for Buffett, it was an early exercise in analysis and pattern recognition. Another formative moment in young Buffett's life was his encounter with the book 1,000 Ways to Make $1,000. It wasn't just a book. It was a window into the world of investing, lighting a spark in Buffett that would never dim. It was here that the seeds of his future investment career were sown, and then came the stock market. At just 11 years old, Buffett made his first investment, buying shares in Citi's service. This wasn't just about making money. It was about understanding the market, learning patience, and looking beyond short-term fluctuations. This early experience laid the groundwork for his investment philosophy that would later define his career. These early years were crucial in shaping Buffett into the investor he is today. His early ventures, his passion for data and patterns, his love for reading and learning, and his first encounter with the stock market all played a part in molding his work ethic, his understanding of the market, and his investment strategies. These humble beginnings laid the foundation for the making of a billionaire. But remember, it all started with a young boy in Omaha selling chewing gum and Coca-Cola door to door. At the age of 11, Warren Buffett made his first investment. A precocious child with an analytical mind, Buffett had already shown signs of a keen understanding of business. But it was this initial plunge into the stock market that truly marked the beginning of his investment journey. He purchased shares in Citi's service, an oil service company. Now, this wasn't some blind gamble or a child's play. It was a calculated decision, backed by careful observation and analysis. But the stock price plummeted soon after he bought it. Instead of panicking, young Buffett held onto his shares. He weathered the storm, demonstrating an early understanding of the stock market's volatile nature. Eventually, the stock price rebounded, and he sold his shares for a small profit. However, had he held onto them a little longer, he could have made a much larger gain. This initial foray into the world of investing was a classroom in itself. It taught Buffett valuable lessons that would shape his investment philosophy in the years to come. He learned about the importance of patience in investing, of not being swayed by short-term market fluctuations. He understood the value of thorough analysis before making an investment decision and the significance of timing in selling one's investments. But perhaps the most impactful lesson was the realization that the stock market was not some mystical entity that one could not comprehend. It was a game of numbers and patterns, of supply and demand, of fear and greed. It was something that could be understood, analyzed, and mastered with patience, diligence, and a keen eye for detail. This early experience was far more than just a child's foray into the stock market. It was a pivotal moment in Buffett's life, shaping his understanding of investing and laying the foundation for his future successes. It was here that Buffett learned to look beyond the immediate, to understand the underlying value of an investment, and to always keep a long-term perspective. With this, the seeds of his investment philosophy were sown. The lessons learned from this early investment would stick with Buffett throughout his illustrious career, guiding his decisions and shaping his strategies. It was the start of a journey that would take him from an 11-year-old boy with a handful of shares to the world's most successful investor. Buffett's investment journey took a significant turn when he came across Benjamin Graham. This was a meeting of minds that would shape the course of Warren Buffett's financial future. Benjamin Graham, known as the father of value investing, had a profound influence on Buffett's investment strategy, steering him towards a focus on undervalued companies with strong growth potential. Graham's philosophy was simple and pragmatic. He looked for companies trading for less than their intrinsic worth. This approach, he believed, provided a margin of safety in case of error in the valuation process. Buffett found this philosophy appealing, and, more importantly, it resonated with his own thinking. Under Graham's tutelage, Buffett learned to assess companies from a standpoint of inherent value. He developed a keen eye for companies that were overlooked by the market but held potential for long-term growth. This strategy steered away from the popular trend of speculating on market trends and instead focused on the fundamental value of a company. Buffett's time under Graham also taught him the importance of patience in investing. He learned that it was not necessary to constantly buy and sell. Instead, he understood that it was wiser to wait for the right opportunity to invest in a company that was undervalued but had strong potential for growth. This patient approach became a cornerstone of Buffett's investment strategy. And so, with these lessons ingrained, Buffett was ready to carve his own path. He had learned from the best, understood the philosophy of value investing, and was now equipped with the tools to recognize and seize opportunities that others overlooked. He had learned to be patient and wait for the right investment opportunity. He was ready to put his knowledge to the test. The influence of Benjamin Graham was pivotal in shaping Buffett's investment philosophy. It gave him a solid foundation and a clear direction. It taught him the importance of patience, diligence, and an unwavering focus on intrinsic value. With these lessons, Buffett was ready to embark on his journey, to apply what he had learned and to make his mark on the world of finance. Warren Buffett was now ready to make his mark on the world of finance. Buffett's investment approach took another major shift when he met Charlie Munger. This meeting marked the start of a lifelong partnership and friendship that would significantly influence Buffett's investment philosophy. Charlie Munger, a fellow investor and business partner, brought something new to the table. Munger believed not only in investing in undervalued companies, as Benjamin Graham had taught Buffett, but also in seeking out great businesses at fair prices. This was a slight departure from the strict value investing principles Buffett had been following, but it resonated with him. Munger's influence led Buffett to realize that it's not enough to simply find a cheap business. The business must also have durable competitive advantages, or as Buffett would later call them, economic moats. These moats could be anything from a strong brand name to a unique business model, anything that would protect the business from competition and allow it to earn high returns on capital over the long term. This shift in thinking led Buffett to make some of his most successful investments. He began to seek out and purchase companies that, although perhaps not the cheapest in the market, had outstanding business models and were leaders in their industries. Buffett's investments in companies like Coca-Cola and American Express are perfect examples of this strategy. Munger also influenced Buffett's approach to diversification. While traditional wisdom suggests spreading investments across a wide range of assets to manage risk, Munger believed in the concept of concentrated investing. This idea proposes that if you've done your research and found a truly great business, it makes sense to invest heavily in it. Buffett embraced this idea, leading to his famous quote, "Diversification is a protection against ignorance. It makes very little sense for those who know what they're doing." This doesn't mean Buffett put all his eggs in one basket, but rather that he focused his investments on a select few outstanding companies. With a refined investment strategy, Buffett was poised to conquer Wall Street. The Munger effect had taken hold, and Buffett's approach to investing would never be the same. His story serves as a testament to the power of continuous learning and adaptation in the world of investing. From owning a farm in Nebraska to starting a pinball machine business, Buffett's journey is filled with strategic investments. Now, let's take a closer look at some of these ventures. As a teenager, Buffett purchased a 40-acre farm in Nebraska. This wasn't just an exercise in agriculture. It was a practical lesson in asset valuation and management, two cornerstones of his future investment strategy. Buffett learned firsthand that the value of a property wasn't just in its price tag, but also in its potential for growth and profitability. Then came the pinball machine business. Buffett and a friend bought a used pinball machine for $25 and installed it in a barber shop. The venture was a success, and they soon expanded to other locations. This taught Buffett the importance of reinvestment and growth. The profits from one pinball machine were used to buy another, and so on, creating a snowball effect of increasing returns. Another one of Buffett's early ventures was a partnership with his sister, Doris, and her husband, Frank. They bought a failing gas station in Omaha, hoping to turn it around. Despite their efforts, the business eventually failed. But this setback was not in vain. Buffett learned a crucial lesson about the importance of understanding the industry and market before making an investment. Then there was Buffett's investment in a textile company named Berkshire Hathaway. At first it seemed like a classic value investment, an undervalued company with potential for growth. However, the textile industry was in decline and the business struggled. Instead of cutting his losses, Buffett saw an opportunity. He started buying more shares, eventually taking control of the company. He then used Berkshire Hathaway as a holding company to invest in other businesses, ultimately transforming it into one of the most successful investment vehicles in history. One of Buffett's most famous investments came in 1969 when he bought shares in See's Candies. He was drawn to the company's strong brand, loyal customer base, and steady profits. This investment marked a shift in Buffett's strategy, moving from undervalued companies towards wonderful companies at fair prices. See's Candies proved to be a lucrative investment, providing consistent profits and valuable lessons in brand value and customer loyalty. Buffett's investment in the Washington Post in the early 70s also stands out. He saw potential in the struggling newspaper and became a significant shareholder. His investment in the media company not only proved profitable, but also solidified his reputation as a savvy investor. Each of these ventures contributed to Buffett's understanding of business operations, investment opportunities, and the importance of reinvestment and growth. They taught him the value of perseverance, the power of compound interest, and the significance of understanding the market and industry before investing. These investments were more than just financial decisions. They were strategic moves, each one a piece of the puzzle that would eventually reveal the bigger picture. Buffett's unique investment philosophy. It was a philosophy that valued patience, analysis, and an unwavering belief in the power of good businesses to generate long-term wealth. But perhaps the most important lesson from these ventures was the power of learning from both successes and failures. Whether it was the failure of the gas station or the success of the pinball machine business, each experience provided invaluable insights and lessons that shaped Buffett's investment strategy. Each of these ventures was a stepping stone on Buffett's path to becoming a millionaire by age 31. His journey is a testament to the power of strategic thinking, continuous learning, and unwavering focus. It's a blueprint for anyone aspiring to make their mark in the world of investing. Warren Buffett's investment philosophy is not just about picking winning stocks. It's about more than just numbers and financial projections. It's a philosophy that has been shaped by years of experience, strategic thinking, and an unwavering commitment to learning. At the core of Buffett's philosophy is the principle of patience. He is a firm believer in the adage, "The stock market is a device for transferring money from the impatient to the patient." For Buffett, investing is not about quick wins or short-term gains. It's about playing the long game, carefully studying the market, understanding the dynamics of the business you're investing in, and then waiting for the right moment to make your move. An essential component of Buffett's philosophy is continuous learning. He is a voracious reader, often spending several hours a day reading financial reports, books, and newspapers. This insatiable curiosity and thirst for knowledge have helped him stay ahead of the curve and make informed investment decisions. He once said, "The more you learn, the more you earn," emphasizing the crucial role that education plays in financial success. In addition to patience and continuous learning, Buffett's philosophy also places a strong emphasis on long-term growth. He doesn't merely look for companies that can turn a quick profit. Instead, he seeks out businesses that have a strong potential for growth over an extended period. He believes in investing in businesses with solid foundations, competent management, and a proven track record of success. Lastly, Buffett's philosophy strongly advocates for ethical investing. He believes that businesses should not only be profitable, but also contribute positively to society. This belief reflects in the various philanthropic initiatives he has undertaken throughout his career. In conclusion, Buffett's investment philosophy is a testament to the importance of patience, continuous learning, long-term growth, and ethical investing. This philosophy, born out of experience and wisdom, has guided Buffett's path to extraordinary success. It serves as a beacon for those who wish to navigate the often turbulent waters of the investment world, illuminating the path to financial success and personal growth. Warren Buffett's journey is a testament to determination, passion for learning, and innovative thinking. His path from a youthful entrepreneur selling gum and Coca-Cola to a titan of the financial world is a remarkable one, filled with invaluable lessons for all of us. Each chapter of his story, each investment and each venture contributes to a grand blueprint for personal and professional growth. His unwavering focus, strategic acumen, and continuous learning ethos have shaped our understanding of what it means to be a successful investor. Buffett's journey serves as a powerful reminder that success is not a destination, but a journey marked by persistence, strategic foresight, and an unquenchable thirst for knowledge. From the farm in Nebraska to the boardrooms of multi-billion-dollar corporations, Buffett's story is a beacon of hope and determination. And so, Warren Buffett's story, while uniquely his, offers a universal message of hope, determination, and the power of dreaming big.